Revenue recognition in nonprofits. Recognizing revenue properly is not just an accounting task, it's a matter of honoring trust. The importance of proper revenue recognition. In nonprofit organizations, revenue recognition is often more complicated than in the for-profit world. Nonprofits must account for a wide variety of contributions, donations, grants, pledges, and special events, often with donor-imposed restrictions or future performance obligations. Proper revenue recognition ensures compliance with ASNPO rules, an accurate reflection of available resources, transparency to stakeholders, and a clear understanding of financial health. Improper recognition can lead to overstated revenue, inappropriate spending of restricted funds, and ultimately, loss of credibility. Understanding contributions, key concepts. Under ASNPO, contributions are defined as non-reciprocal transfers of assets. This includes cash donations, securities, in-kind goods, government and private grants, and membership fees, when not based on an exchange. Contributions can be categorized as follows. Restricted contributions. Funds that must be used for a specific purpose, or within a specific time frame. Unrestricted contributions. Funds that can be used at the organization's discretion. Endowment contributions. The principal must be maintained in perpetuity, while investment income may be used. Deferral method versus restricted fund method. ASNPO permits two models for recognizing contributions. Deferral method. Restricted contributions are first recorded as liabilities, deferred revenue, and recognized as revenue only when related expenses are incurred. Example: a $50,000 grant for a 3-year program is recognized gradually over those 3 years. Restricted fund method. Restricted contributions are recognized as revenue in the related fund when received. Example: a donation to a scholarship fund is immediately recorded in the scholarship fund revenue. Key points. Organizations must select a method and apply it consistently. Changing methods requires a retrospective restatement and disclosure. Choosing the right model impacts not only accounting, but also financial management, reporting, and even fundraising narratives. Recognizing pledges and grants. Pledges, or promises to give, are only recorded as revenue when collection is reasonably assured. If there's uncertainty about collectability, the pledge should not yet be recognized. Grants are recognized based on the terms. Unconditional grants, recognized immediately. Conditional grants, recognized only as conditions are met. Example: if a grant requires a progress report before releasing the second installment, then revenue from that second portion should not be recognized until the report is submitted and approved. Key tip: always review grant agreements carefully for performance obligations, milestones, and reporting conditions. Membership fees, event revenue, and sponsorships. Revenue recognition depends on whether the transaction is reciprocal, an exchange of goods or services, or a contribution. Let's break it down. Membership fees. If the benefits, like magazines or services, are minimal, treat it as contribution revenue. If significant, recognize revenue as the services are rendered. Fundraising events. Ticket sales that cover event costs are treated as exchange transactions. Anything beyond that is recognized as contribution revenue. Sponsorships. If a business receives substantial advertising or promotion in return, treat it as earned revenue. Otherwise, treat it as a contribution. Correctly distinguishing between contributions and exchange transactions ensures both compliance and transparency. Common mistake to avoid: never recognize restricted contributions as immediate, unrestricted revenue. Doing so can mislead stakeholders and expose your organization to compliance risk. Workbook practice. Mini exercise 1: Deferral versus restricted fund method. Your nonprofit receives a $100,000 grant on December 1, 2025, to be used over the next 2 fiscal years for a visible minority leadership program. Question: how would you recognize this grant under the deferral method? How would you recognize it under the restricted fund method? Hint: consider whether you defer recognition or recognize it immediately in the appropriate fund. Mini exercise 2: Pledge recognition. You receive a signed pledge for $20,000, promising to pay in 2 annual installments of $10,000 starting next year. There's no written guarantee of collection. Question: should this pledge be recorded immediately? Why or why not? Under what conditions would you recognize it now? Mini exercise 3: Challenge, event revenue accounting. You host a gala dinner. Tickets are sold for $150 each. The fair market value of the dinner and entertainment is $70. You sell 100 tickets. Question: how much should be recognized as event revenue, the exchange transaction? And how much should be recognized as a charitable contribution? Hint: separate the fair value of goods and services from the contribution amount. Key takeaways from Chapter 5. Revenue recognition depends heavily on donor restrictions and conditions. Organizations must consistently apply either the deferral method or the restricted fund method. Pledges should be recognized only when collection is reasonably assured. Fundraising and sponsorships require careful distinction between contribution revenue and earned revenue. This material is taken from my book entitled Mastering Canadian Nonprofit Accounting Standards and HST, Confidently Managing Your Books, written by Sammy K. And it is available exclusively on Amazon.